Hello, everybody. Thanks for checking in. Let's take a quick look at SPY. My name is Mark with Stock Market Jobber. I'm a former institutional trader. I was the head of trading at 3 different money managers. I've overseen mutual fund trading, hedge fund trading. I was a market maker. I also worked directly for Mario Gabelli and also for Steve Cohen. So when it comes to trading, I've been around the block a few times, and now I kind of want to share what I've learned. So let's just take a quick look at the S&P here. So we're up on this news. We got a lot of earnings tomorrow, but I just want to point out how we're up back to this resistance level. When a market is trending higher, it's because there's not enough there's not enough sellers to fulfill all of the buy orders. So the buyers are forced to pay higher prices or pay a premium to get the sellers in off the sidelines to pull them into the market. When we get to a resistance level, well, all of a sudden there is enough supply to fulfill all of the demand, and the buyers don't need to pay higher prices. Okay? So when we get to resistance, a lot of times we get a sell-off. That's because the sellers or the investors who created the resistance with their sell orders start to get antsy that they're not going to be able to sell their shares. They sense that there are other sellers around. That's why, and because of that, they decide to sell at a lower price. In other words, this line here is at 411. Someone might say, you know what? I need to sell at 410 because if I'm at 411 and someone else is at 410 and a half, well, they're going to go to the person who's at 410 and a half. They're not going to pay more than they have to. And it starts a snowball effect. The sellers start to undercut each other. And that could lead to a sell-off like it has these last couple of times we've hit resistance. So I'm not necessarily sure that that's what's going to happen now. There's a lot of earnings tomorrow, but just assume that the market rolls over and starts to go lower. There's a way to make money off of that without buying puts or without shorting stock or without being in the options market. You can buy an inverse ETF. This ETF here, the Pro Shares Short S&P 500 ETF, is designed to go in the opposite direction of the S&P 500. So if the S&P 500 goes down, this will go up by about the same amount. So if the S&P goes down by 2%, this will go up by about 2%. All right? So there are ways to make money in down markets, and in a lot of ways, it's even easier because markets go down faster than they go up. So it's easier a lot of times to make money off buying an inverse ETF in a bear market than buying a regular ETF in a bull market. If you're really bearish, this ETF uses leverage. This will go in the opposite direction about 3 times what the S&P does. So if the S&P goes down 2%, this will be up 6%. If the S&P goes down 3%, this will be up 9%. So one of the things we talk about at stockmarketjobber.com is different ways to make money in different markets, or in different market phases, I should say. So please check out our website, stockmarketjobber.com. Please subscribe to our YouTube channel if you want to receive notifications. And just remember, a good trader can make money in any kind of market, up, down, sideways, inflationary, deflationary, you name it. So check out our site and you'll learn more. Thanks, everybody. Have a good day.